Hey everyone, we got some huge news for SoundHound AI stock investors regarding its balance sheet and its debt repayments. I'm going to go over what specifically SoundHound AI did and what it could mean for SoundHound AI stock investors. So let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so SoundHound AI reached an agreement with its lenders to prepay its outstanding $100 million in debt in full. So what that means is they owed lenders $100 million, but they didn't have to pay that back right now. They could have paid it back later, next year, the year after that. It wasn't due for a while. But since SoundHound AI had some cash on hand, they called up these lenders, or maybe the lenders called up SoundHound AI, and they likely gave SoundHound AI a choice and said, look, why don't you pay this earlier and thereby it'll save you some money down the line. You've got the cash right now. Why don't you use it to pay down this debt? And that's what SoundHound AI decided to do. Remember, SoundHound AI stock over the last year is up, right? It's up by a lot, actually. Earlier in the year, SoundHound AI stock was trading at around $2 per share, and then it exploded to around $10 per share. So SoundHound AI used this higher stock price to sell more shares of stock and get more cash. So now SoundHound AI took that cash that it raised from the stock sale, and one of the things it chose to use it for was to pay down debt. And so it's always something that corporate finance looks at company-wide. They look at the cost of capital. There's only two ways you could finance a business: through equity or through borrowing. And business owners, business management has to choose one. And they typically choose using several factors. When interest rates are lower, they can borrow because they're going to pay a low interest expense. When the stock price is exploding, they can sell the stock price because investors are willing to buy at higher prices and give the company more money. So management is always monitoring the situation, seeing what's going on with interest rates, with stock prices, and always trying to fund the capital, fund the business with the lowest cost of capital possible. And so this is what that move was from SoundHound AI management. They observed the situation throughout this year. They realized the stock price is soaring, and the stock price was soaring despite the company's profit not really expanding, right? SoundHound AI stock price exploded because of the enthusiasm surrounding artificial intelligence, because of NVIDIA's interest in SoundHound AI, and the stock price rose ahead of fundamental improvement in the company's business. Well, the company did improve. Revenue grew nearly 80%. They made significant improvement in cutting their losses on the bottom line, but the stock price rose much further than those increases in fundamental performance justified. And that's what management saw as well. They said, look, our price is rising ahead of expectations, so let's take advantage of that. Let's sell stock and let's pay down debt. All right, so moving on. This enables SoundHound AI to save over $55 million in interest and fees. The transaction also frees up $14 million of restricted cash. So this still leaves the company with $180 million in cash, and now they have no outstanding debt. So now they have more flexibility. And this is what the management said, the CFO saying that with this massive opportunity to deliver AI around the world and our strong cash position, we've improved our financial profile. We now have a capital structure free of debt, which will allow us to be even more flexible in increasing customer demand for our voice AI solutions, which is true. I think this was a very prudent move from management. I think management realized the situation and capitalized effectively. Your stock price increased way too quickly and way ahead of performance improvement. So you capitalize on that as the CFO. You sell the stock, and you pay down the debt because the debt interest rate was really, really high. It was burdensome on the company. Let me share that with you. So in the company's latest quarter, which ended March 31st, 2024, they paid $5.664 million in interest expenses. $5.664 million in interest expenses. The company's total revenue was just $11.59 million. So they paid almost 50% of their total revenue in interest expense. That's a burdensome interest expense. And when you're a company like SoundHound AI that's losing so much money on the bottom line, you see net income was negative $33 million on revenue of just $11.5 million. So they're losing 3 times more money on the bottom line than they're generating in revenue. This is not an attractive situation for a lender. The lender looks at this and says, I might lose the money that I let this company borrow. And so they're going to ask for very high interest rates to borrow to this kind of company. And so they have to pay these higher interest rates if they want to fund the business, if there isn't investor interest. But in 2024, there was a lot of investor interest. Investors were willing to buy this stock, even though the price was exploding. Investors were still willing to buy the stock. So the management team said, this is an opportunity. Let's sell the stock because there's investors that are interested in buying it, and let's use it to pay down this debt. That's a really, really big burden on the company's financial statement. And so that's what they did. They raised capital and they paid off this debt. So now this $5.664 million, the second quarter, they'll still record this expense because this happened during the second quarter. But starting the third or maybe the fourth quarter, depending on when this deal closes officially, the company's interest expense will decrease meaningfully. So that will help the company's bottom line. It'll help its income statement because that's less income, that's less expenses coming off of the company's income statement. And I shared with you that they're selling a lot of stock, and you can see that it's diluting shareholders. The number of shares outstanding increasing from 205 million up to 286 million. So a big increase in the number of shares outstanding. This was also partly to help fund an acquisition as well. The company recently acquired Sync, which is going to help it expand in restaurants with its voice AI technology. So overall, I think it's a prudent move from management. I think it's a smart move from management, capitalizing on this investor interest in SoundHound AI stock to pay down that debt and reduce the interest expense. Does this make SoundHound AI stock more attractive? It does. It does make SoundHound AI stock more attractive because now it has lower interest expense, less debt, and that was funded by previous buyers of SoundHound AI stock. This comes at the expense of those individuals that paid those really high prices for SoundHound AI stock. Unfortunately, they are the ones that funded this improvement in the company's income statement. And so now the company has a better capital structure. Still, I do not have SoundHound AI stock rated as a buy. Even after this improvement, it's a step in the right direction, but I still don't like the company's balance sheet. I still don't like the company's income statement, I should say. 33 million in losses on the bottom line for revenue of just 11.59 million. It's still too much out of balance for me, a little too early for me to recommend, but I can still realize and recognize the company's exceptional improvement, exceptional revenue growth, and capitalizing on this rising AI wave. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.